thank you for checking in on what a personal pension plan can do for you. Together with JP Laporte from Integris Pension Management, we would like to present a case study. Now, Claude is a small business owner, and it's incorporated in 1995. But in fact, the personal pension plan is also suitable for any franchisee or an incorporated individual. And that incorporated individual can be a doctor, a dentist, or a lawyer. Now, Claude wants to build the largest retirement nest egg possible, of course, and he wants to claim the largest corporate tax deduction that he can. And here are the facts. Claude is 45, he's happily married to Marie-Claire, and they have 2 children, Mario and Lise. He's been operating Ananda Mechanical since 1995, and Ananda pays him an income of $125,000 a year, T4 income. He's accumulated $400,000 in RSPs, and he's pretty conservative, but he likes to get at least a 5% return each year. And to defer paying taxes, Claude will draw on that at age 71 when he retires or plans to retire. Ananda Mechanical, he pays tax at 26%. Knowing that there's a better way for Claude to use his corporation to achieve a comfortable retirement for himself and Marie-Claire, Beacon Insurance introduces Claude to the benefits of setting up a personal pension plan through his corporation, Ananda Inc. And to take you through the meat of the presentation is JP Laporte. Jean-Pierre founded Integris Pension Management with the intent of providing better solutions for a specific demographic of investors who are, like many, looking to minimize taxes while protecting their assets. JP has worked over the past decade as a pension lawyer for a number of prestigious firms, law firms in Toronto, such as Osler, Hoskin and Harcourt LLP, Bennett Jones LLP, and Fasken Martineau LLP. He has dedicated himself to improving pension legislation. He gets really excited and is passionate about pension planning and plans. So I'll leave it over to you, JP.
Well, thank you, Rick. So what I wanted to start with is a bit of an overview of what a personal pension plan or PPP is from a legal perspective. I think that would set the context. So first of all, a PPP is what we call a combination registered pension plan, which is made up of 3 components. And you can see on this slide that the 3 components are the defined benefit component, or the DB component, the defined contribution component, DC, and the additional voluntary contribution component, or AVC. And the beauty of a PPP is that these 3 components work together harmoniously and give the business owner the highest level of flexibility possible. So there's the ability every year to flip between the defined benefit or DB component to the other 2 components and vice versa. This is very important, as we will see later on in the presentation. So going back to Claude, we know that the big picture is this. By being able to use the more generous rules relating to pension plans, he will be able to enhance, to add, in addition to what he could have done in an RSP, an additional 1.6 million by the time he turns 71. So what we do is we start with what an RSP can deliver, and we add on $1.6 million for Claude and Marie-Claire to enjoy in retirement. And this is shown from the table up here under PPP Advantage. So you can see graphically that if you stayed in an RSP, if Claude stayed in his RSP and maximized his RSPs every year, again, we've assumed a 5% rate of return on assets. The evolution of the assets is along the light blue line. But because he's upgraded to an PPP, and under pension laws, he's allowed to put more money, you can see that that additional money will, of course, deliver returns and creates this $1.6 million gap by the time he turns 71. But how is that possible? How can it be that the PPP rules allow for much more in terms of contributions than RSP rules? It seems unfair. And how much? What is this? What are these extra contributions? Well, this executive summary tells us. You can see that by age 71, Claude will have contributed over $733,000 more than what is permissible under the maximum RSP contribution rules. So that's a lot of money. And what are the sources of these extra contributions? Well, let's break them down. So first of all, annually, a PPP allows you to contribute more than an RSP. So you can see this left-hand column called current service contribution that shows the annual contributions permissible under pension laws. And when you compare them each year to the RRSP maximum contributions, you can see that there's a gap developing between those numbers. Just if we were to take one single year as an example, at random, here's the year 2033. In the year 2033, Claude would be able to put 48,480 in his PPP, whereas he's only allowed 32,080 in his RRSP. So that's a $16,000 and change additional tax deduction and contribution that is permitted just in that single year. And this process repeats itself all the time at different gap levels. But that's not the end of the story, because we also have the ability to make extra contributions called special payments every 3 years on the basis that the assets inside the PPP are only growing at 5%. And under pension rules, the government would like those assets to be growing at 7.5%. So given that there is a shortfall in terms of the returns, that gives the company an ability to contribute additional tax deductible amounts every 3 years when we file a valuation. And this table shows you what these triennial valuations yield in terms of additional corporate tax deductions. But there's more, because there's also some extra personal tax deductions permitted. You can see that in the first year, Claude is allowed a $14,500 personal tax deduction if he contributes it to his RSP or to the ABC component of the PPP. And then in subsequent years, he's allowed another $600 annually. So that creates more money that's going to be growing tax sheltered and more personal tax deductions along the way for Claude. So what do all these add up to? $753,053. That's a significant upgrade over what someone could hope to tax shelter using an RSP. But if Claude says, hey, well, I don't want to wait until I'm 71 to benefit from all of these advantages, what happens? So let's say that Claude decided to retire at age 58 instead of 71 in the year 2033. Well, that's possible because you can retire at any age after age 50. So you don't have to wait till you're 65, and you certainly don't have to wait till you're 71. So let's look at age 58. At age 58, what happens is that we have him retiring, Claude retiring, on a basic pension of $99,438. That's the annual pension he's entitled to. But Claude is thinking that he's got a lot of money in his corporation and he'd like to get it out efficiently. Well, there is a possibility we can do what's called terminal funding. So if you look at the right-hand most column, terminal funding, you see that there is the ability to contribute over $1 million to the pension plan in order to allow Claude to retire on an early retirement pension at age 58. And when the company makes that terminal funding contribution of over $1 million, it is a corporate tax deduction for the company. Remember that the company is paying tax at 26%. So really what the company has just done is pocketed a bonus tax savings of $266,000 instantly. But from Claude's perspective, instead of collecting $99,000 per year, which is the basic pension in the first row, or column, sorry, now Claude can collect an early retirement pension of $170,000 and change. Well, that's a 72% upgrade. over what he normally would have received had he retired early. So the question is that the end of the story? Is there more? Well, there is, because Rick told you that Claude is married to Mary Claire and can do pension income splitting with a spouse. Therefore, Claude would only declare income on half of his annual pension, $85,447, and Mary Claire would have to pay tax on her tax return for the other $85,000. That's how pension income splitting works. So when we're looking at the impact of doing this, we have Mary Claire paying tax, of course, Claude paying tax, and we can see the taxes owed on this table based on the taxable income. And we add it up for the couple. So the couple, in terms of total taxes owed, would be looking at a tax bill of $44,566. But if Claude did not do this income splitting, normally his tax bill and his $170,000 pension would be $59,252. So just by doing this couple just saved $14,686 every year. And you might be wondering, well, when can pension income splitting start or begin, because it's such a good thing? Well, it can start as early as age 50. As you all know, you need to be 65 to do income splitting with a RIF, a Registered Retirement Income Fund. So right away, we have a 15-year advantage over people using RRSPs and RIFs. And if we look at the annual advantage of $14,686 and we multiply it by that 15-year advantage, that's $220,000 of taxes saved. So B can just save this couple $220,000 simply by suggesting turning on the pension sooner. This is the kind of stuff that is really powerful, because if we can create savings immediately for couples just by using pension laws, this really enhances the value proposition. So the question then is there more? Well, there is, because the investment management fees are also tax deductible to the company. So here, if we're looking at this table, we can see the evolution of the assets invested in the plan with interest at 5%, growing progressively year after year until age 71. So let's again take an example. Again, just at random, the year 2033. At that point in time, based on these projections, there would be about almost $2 million, $1.956 million sitting inside of the plan. Those are the assets under management. And let's say that the fees are 2% of those fees, of those amounts, sorry. Well, that's an annual fee that year of $39,130, multiplied by the corporate tax rate of 26%. So the company just saved $10,000 in taxes just by claiming those investment management fees as a tax deductible expense in that 1 year. Of course, this process repeats every year. And just by way of comparison, this tax savings of $10,000 is more than 4.5 times the annual fee to run the program. And we can see the fees listed here, and these are fees with HST added. Okay. What about if Claude decides to do nothing and decides to retire with an RRSP? How much money would he have by age 71? Well, based on our model, at age 71, the RRSP would grow to over $3 million. So there's a real gap here between what the PPP can do, 4.6 million, and the $3 million in the RSP. And this is the gap of 1.6 million that we've discussed at the very beginning of the presentation. But what kind of pension can you get with an RSP that has $3 million at age 71? Well, based on the RIF annuity purchase rates at age 71, you would be under RRSP, you would be entitled to about $240,000 annually. However, if you were to do a PPP at the same age, and this is without terminal funding, the annual benefit would be $328,000. So that's about $87,000 more each year, or a 36% upgrade. But recall that this 36% upgrade came with no additional cost because the tax savings paid for the cost of the program multiple times over, and without taking any additional market risk. Because whether you're using an RSP or a PPP, we've assumed that the assets are growing at 5%. So really what we've done is increase the standard of living of Claude and his wife by 36%, which is not too bad. We've already deducted all the fees, so it's clean. So this is a net return. It's not, we don't have to worry about subtracting the fees. And we have taken no additional market risk, because the big question is, why take risk with your retirement savings? And of course, and we didn't talk about this, but this is some of the additional benefits of the PPP. The assets are also creditor protected because pension legislation protects the account. It's always the client's money. And we've saved the company a lot of taxes as well. And since Claude controls and owns the company, that's more money in his pocket. So what we've done, in effect, is transfer risk, in Claude's case, from Ananda Inc. to the PPP. We move money from a taxable environment into a non-taxable or tax-deferred environment. But there's more, because remember that Claude and Mary Claire have 2 kids that are working in the family business. They are drawing T for income. So now Beacon Insurance can set up a family PPP. All of them can participate in a single PPP because they're all drawing T for income. They're all employees. Of course, at some point in time, Claude and Mary Claire may wish to retire and start drawing their pensions. Maybe they want to trigger some terminal funding. Maybe they want to suck money out of Ananda Inc. into the PPP so that they have a higher early retirement pension. Lots of options, lots of deductions. But should disaster strike and Claude and Mary Claire pass away, because this is not an RSP, all the monies that were inside the PPP that were earmarked to pay them pension now is recharacterized and is considered pension surplus. It's stuck inside the plan, so there's no deemed disposition, no tax, no probate fees, no provincial tax either. It doesn't even flow through the estate of the deceased parents. But Mario and Lise are plan members. So now they have access to all of that surplus to fund their own pension. Now, if we want to know what that means in dollars and cents, if we assume that the death occurred at age 71, we know by looking at the graph that there's over $4.6 million sitting in the pension plan at that age. And normally, at those levels of income, the estate would be taxed at 50% or more. But because we were able to convert that money into surplus, Mario and Lise just saved over $2 million in taxes. So really the message here is thank you, Mom and Dad, for setting up a PPP, because we're $2 million richer. So I'll turn it back to Rick for final concluding remarks.
Well, thank you, JP. Well, there always is more, but for today, that's the show, folks. Together with Integris Pension Management, we're here to walk you through the next steps. And thank you for sharing this time with us and for allowing us to share what we know. And we would really be honored if you would chat this up with your business associates and colleagues that do qualify for a pension plan. Here are our contact details, and we're here to help.